I also have with me Sophia Sanders. Sophia Santos is an economist with a specialization in sustainability and sustainable financing. Has 23 years of professional experience among banks, companies, NGOs, and the public sector. And since November 2019, she works as an agent of change in organizations, as a founder of the consultancy company Systemic. And since January 2020, she and her team are helping Grupo Credito Agrícola to become a front runner in the sustainability field. Let me point a first point regarding sustainable and regenerative financing instruments. And I'd like to ask some questions for Sophia. So let's start with you. Different countries across the world have adopted new initiatives aiming at a gradual transformation or to greening their financial systems by sponsoring their investments towards an inclusive, net zero carbon and resilient economies. So according to the World Economic Forum, 4 to 5 trillion US investments will be needed until 2030. This raises the need for discussion about how to finance these projects, particularly in the context of a capital rationing. Under this framework, ESG ratings play a key role in the process of obtaining financing, particularly debt. In addition, we have a number of new players entering the market with very relevant role, for example, in the certification process. So here, or based on this framework, I would like to raise two questions, which are, first, what are the main financing instruments available for companies to implement ESG investment strategies? And second, are banks prepared for all these changes, namely the application of ESG ratings?
Thank you for the invitation. It's a pleasure to be here today. And your two questions are quite large in terms of answers. So once at a time, the first one is about what type of financial products there are available. So you can find in the market different products, from small loans for companies and for households to improve their energy efficiency. For instance, that in Portugal is quite often, or also some special loans to the purchase of more efficient vehicles. So I'm starting with these retailing type of services and type of products. But of course, then you can also find the green bonds, sustainable bonds, sustainability bonds, and all of that. Usually this green bond, probably from all of these three, is the largest product that is being issued. I think this year has been quite a large increase in green bonds around the world. It was about 3% of all bonds in the world, between 3 and 4% were green. And I kind of heard and read some estimations that eventually this year will go up to 8 or eventually 10%, which is a great increase, despite the fact that it's still small. But green bonds, usually people think it's only for large companies, and it's not. It has started with large companies. In fact, it has started with governments and municipalities. For instance, in the US, lots of the green bonds are issued by municipalities because they can. The biggest countries that issue green bonds are the US, China, and France, and then some other countries which might sound different because many of us think that US and China don't do that much. But guess what? In terms of green bonds, of course, they are large countries, but in terms of green bonds, they are also the largest issuers. Many people think green bonds is just for large companies, but I would like to take the opportunity to say that it is not. SMEs can also raise capital by doing green bonds. And by doing that, typically they should get first a ESG rating. And of course, that requires investment. I would encourage companies to see this as investments and not as costs. There are two different completely things. One is a cost, is a sunk cost. The other one is investment that will provide with innovative and increasing prosperity in the company. And I think that's what we are talking about. Of course, there is also the green loans, a bit more sophisticated as well. It's a, let's say, one-to-one financial product approach, because it's when one company agrees with the bank for a loan, the interest rate will vary according with the fact that if a company reaches a specific goal or not. So if a company sets up a goal, it's imagined to decrease 20% of CO2 emissions during year 1 and 2. If they do that, the interest rate is X. If they don't reach that, the interest rate is X plus Y. So this is something that I think in Portugal only 1 or 2 large companies have done it. But then again, it's something that could be done more often. So, financial products are a bit sophisticated in terms of the green aspect because are really related with the bonds, the most that we talk about. But the thing is that we should realize that green financial products are much more than just loans and bonds. It's also about how can banks help companies, especially SMEs, to get prepared to the great challenges that they are going to have in a very short time because they have to reply. They will have to respond to lots of questions in terms of environmental and social data that is needed for investment funds. We also have quite strong regulation on private equity, for instance. So private equities will need to disclose environmental and social information on all their investees, and therefore companies they will need to supply with that information. So sustainable finance is much more than just, the green bonds that everyone seems to be obsessed, which is a great product, but it's very much about also how can we use and understand the level of sustainability, let's say like this, of a company. And with that data, how can also the financial institution help them to move forward and to improve their environmental and social performance?
Let me just ask you another question regarding with the ESG ratings and if banks are in fact prepared for this change. Because as we know, banks also have to, when analyzing, when performing some credit risk analysis, more than using the standard approaches, they also have to include ESG metrics in their analysis. And of course, that will also impact their risk-weighted average assets. So if you want, the capital ratio for the banks will be affected by this kind of loans, because if they are not providing loans to a firm that comply with the ESG criteria, the capital ratio will be lower. So what do you think about this?
I think it's one of the major challenges for the banking sector. I think some banks will probably need to merge with others just because of this strong regulation, because this regulation is much stronger than the other type of regulations that banks have seen before. And this is actually different banks saying, it's not me stating. Many people say, well, if you take into account a DMIF, sorry, I'm saying the short expression in Portuguese, what we have in here with the taxonomy and with the EU regulation, it's much more demanding. So it is a massive challenge. If banks are prepared, some banks are better prepared than others, like always. Of course, I'm here representing the Credito Agrícola, so of course I have to say what we have been doing. We have trying, to be more prepared, but that implies a massive change of culture. It implies lots of training internal so that people become aware and with knowledge. It also implies a lot of resilience because, of course, we as human beings, generally, we don't like change. We like to live in our comfort zone, and everything it's about sustainability, especially within the financial system, is all about being in a not comfortable zone. And special, it's all about having a position that is very different from the other people in the room. And that's a cultural change. That's something that only with knowledge, that's why training is so important at all levels, not just training the people that work in the bank, but also training of the clients and training of the suppliers. That's really relevant. And of course, we also try to understand better the level of ESG, let's say ESG rating of our clients. And therefore, we started to implement some questionnaires for every new loan that companies might ask in order to understand how can we be sure that we can help the clients to improve from one specific level of sustainability to a greater one. So if banks are prepared, generally I would say no, because this has been in the agenda for the at least last 20 years. Regulation is only out in the last 2, and many financial institutions are at the moment not in compliance with the regulations. So therefore, they never actually thought that this was going to happen. And it did. So now everyone is running. And I think all of us, we need to run very fast. And I think Credito Agrícola is making a big effort to run faster and earlier than the others.
Okay, great. Thank you. I will now move to another subject, and this is for Tom. So Tom, regarding the role of asset managers. So the way asset managers direct capital not only shapes the financial returns, but can also affect the type of impact we have on the world. So asset managers have the power, in my opinion, to influence corporate behavior, mainly if they make their investment decisions based on ESG criteria. So in fact, there is more than just a relationship between risk and return. So a third dimension, impact risk, needs to be embedded into the investment process. So regarding your experience and even knowing that there is a new generation of asset managers, still the pioneers, who use strategic and systematic sustainability thinking for the evaluation of entities to support. So in this context, let me just raise two questions. First, has the relationship between these two outcomes evolved? And is there a fundamental shift in how companies are viewed and valued? And of course, based on your experience regarding the future fits experience on the ground, what do you think on this?
Great, thank you. Yeah, I think I agree with Sophia. There's a lot to unpack here. And I think that, as with banks, I think the variety of different ways in which asset managers are stepping up to the challenge. And I think that's because, there's diversity in the approaches that asset managers take to managing the capital. We have a lot of institutions that are more passive in their approach. Others are more active in, choosing the companies that they invest in. I'm here talking about specifically public equity primarily. So there's a real variety and scope of different approaches that organizations are taking. There are a number of institutions that, focus more on those businesses that are offering, sustainable opportunities that are relevant for the future, that are aligned with the SDGs, all the way through to organizations that, are just, solely screening out maybe oil and gas, tobacco and weapons and calling that ESG as well. So there's a very broad breadth of how institutions are embedding ESG, environmental social governance factors, into their investment decision making. I think one of the things that I've personally seen is a shift towards much deeper integration of environmental and social factors into company valuation. I think it's still very, very difficult to do that at that fundamental level, trying to understand, cash flows and all these challenges. Because I think we're stood on a precipice right now. If you look at, the number of, net zero commitments that have been made, if you look at how consumers and other customers are looking across environmental and social issues, I think a lot of these things are going to change very, very rapidly. I think there are going to be a number of businesses whose actual business activities are no longer going to be, welcome in that world that we're all striving for. So how can you factor in, such rapid change? That's a really difficult thing for investors to do. So I think the first trend that I've seen is, an attempt to at least go into that detail and try to incorporate these issues into that fundamental company analysis. I think the second trend that I've seen is really investment in stewardship and engagement. So active owners are really beginning to support and encourage businesses to kind of go above minimum standards so that they're not being hit by the forthcoming transition risks and so on and so forth. But acknowledging that, changing from zero to perfect right now just isn't feasible for the majority of companies. So I'll end it there. I think, there's kind of a cliched response to the biggest challenge here that I think was coming out in Sophia's comments as well around data and information. I think that we as kind of a finance community right now, are still a little too reliant on out of the box company ratings. When you look at what the ratings that research managers are producing, they differ so wildly between each other. They're measuring different things. But also when you dig into, an individual research manager, they're still finding it difficult to unpick the solutions of tomorrow from the problems of today. One example being, there's a recent example of Beyond Meat, which is an alternative proteins company, where a research manager was saying that the rating was very similar between that company, which I view as part of the solution of the future, to one of the world's largest meat producers. And, with all the, the disadvantages and the impact of meat production. So I think we're still a little too reliant on those ratings. And I think asset managers have realized that and are now kind of deepening their engagement on these issues and trying to fundamentally understand where the company's adding value.
And using one part of your discussion, it's about SMEs. And for us in Porto, it's something that is really important. So knowing that in Europe, 80% of GDP contribution comes from SMEs, how can we influence the behavior of these firms? We know that it's much easier to analyze compliance with ethics criteria for listed companies. How can best practice be trickled down to SMEs? What do you think?
SMEs understand that money will be associated with ESG good practices. So I think that can be the first trigger. Not that I'm saying that SMEs, they are not concerned with anything else than the money. I'm just saying that they are usually very busy. I think Portuguese SMEs, they do wonderful things. I don't know how can they cope with the whole system and still export as much as they do. So what I'm trying to say is that the access to money will be related with ESG performance, not only on the banking side, as we can see now, Credito Agrícola already doing some kind of ranking to understand what is the level of ESG practices among the clients. For now, it's to understand, and later on, we will see what we can do with that data. But also banks will need to report in 2024 the green asset ratio, which means the percentage loans that it's aligned with the EU taxonomy, which means the percentage of loans that it's aligned with the 6 environmental goals and potential with some other social goals that are about to come out, which means that the capital requirements will be related with the level of environmental and later on social risk of a bank. And this is already in July 2022, the capital requirement directive will change, will be updated, and banks will have to incorporate ESG issues on their credit analysis, which means that any SME, sooner or later, when it starts to engage with the bank will need to ask some questions. Another thing is the finance that is coming from the European community also. More than the majority of the funds will be targeted at projects that can prove that they contribute to the carbonization or circular economy. So once again, the projects themselves, they need to comply with that. And even the recovery package, it needs to be compliant with the taxonomy. All the money that the resilience recovery plan, all this money should not significantly damage any of the 6 environmental goals that the European Commission has defined in the taxonomy. Okay? So that is really critical. So how can SMEs go for it? I think there is no other way. And it's not that complicated. And that's another thing that I would like to demystify is that sometimes I hear people in the sustainability area saying, well, I think SMEs, the Portuguese SMEs are still very, not able to deal with sustainability issues. And I just don't agree, because if they are able to export in such a terrific and difficult environment, of course they are able to identify and to communicate the social and environmental information that banks and that investment funds and that the government will be asking. And then they will be able to improve, because they have done it in other areas. Why should they not be able to do it in sustainability? So just to finalize, we should explain this more to the SMEs. Most of the SMEs, they don't know that they have this short future in front of them. And when they do, they recognize it. Sometimes I do training to SMEs in their meals, which is wonderful. And I can see the positive response because I can already feel that clients are asking for this information. Some investors are also wanting to know what the best practices are. But this information needs to be much more mainstreaming towards every single SME, because the only problem we have is that most of the SMEs don't know about this. If they knew, they will understand that it's reasonable and that makes sense.
Right. Right. Yeah. Thank you so much for your opinion. Thank you so much for being with us.